The Fed rate cut is a reduction in the interest rate that the Federal Reserve charges banks for borrowing money from it. The Fed uses this tool to influence the economy by making borrowing cheaper or more expensive. When the Fed cuts rates, it lowers the cost of borrowing for consumers and businesses, which can stimulate spending and investment. Conversely, when the Fed raises rates, it makes borrowing more expensive, which can slow down the economy and curb inflation. Traders are betting on a Fed rate cut in July following the April inflation report, which showed that consumer prices rose by 4.9% from a year earlier, the lowest rate in 2 years. The report also showed that some key service costs, such as airfares and hotel prices, declined in April. These signs of moderating inflation suggest that the Fed has more room to pause its aggressive tightening campaign, which has lifted interest rates 10 times since 2021 to above 5%. Traders think that the Fed may need to cut rates later this year to prevent a credit crunch and a recession, as recent troubles in the regional banking sector have raised concerns about the availability of loans. According to Fed funds futures, traders see a 50% chance of a quarter-point rate cut in July, which would bring the Fed funds rate down to a range of 4.75% to 5%. In this section, we will analyze how the inflation slowdown in April could affect the Fed's decision and the market outlook. As you may recall, inflation is the general increase in the prices of goods and services over time, and it affects the purchasing power of consumers and investors. According to the latest CPI report, inflation rose 4.9% in April from a year ago, less than expectations and the lowest annual pace since April 2021. This was mainly driven by a moderation in shelter, gasoline and used vehicle prices, which had surged in previous months due to supply constraints and pent-up demand. However, inflation still remains well above the Fed's 2% target, which is based on a different measure called the Personal Consumption Expenditures (PCE) price index. The Fed has been raising interest rates since March 2022 to combat inflation and cool down the overheated economy. The Fed's benchmark rate is now at 6.25%, the highest level since 2007. The Fed has indicated that it may pause its rate hikes as it assesses the impact of its actions on the economy and inflation. The Fed Chair, Jerome Powell, said last week that he expects inflation to moderate as supply bottlenecks are resolved and base effects fade. Base effects refer to the comparison of current prices with unusually low prices a year ago, when the pandemic hit the economy hard. However, some Fed officials and market participants are concerned that inflation may prove to be more persistent and widespread than anticipated, especially as labor costs rise due to worker shortages and wage pressures. The New York Fed President, John Williams, warned on Tuesday that he expects inflation to remain an issue for some time. So how does this affect the Fed's decision and the market outlook? Well, it depends on how the inflation data evolves in the coming months. If inflation continues to slow down and converges to the Fed's target, then the Fed may be able to stop raising rates, or even cut them if the economy shows signs of weakness. This could boost consumer spending, business investment, and stock prices. However, if inflation remains elevated or accelerates further, then the Fed may have to resume its rate hikes or even tighten its monetary policy more aggressively. This could dampen economic growth, reduce corporate profits, and weigh on stock prices. Therefore, traders should pay close attention to the inflation data and the Fed's signals in order to adjust their strategies accordingly. Inflation is one of the key factors that influence interest rates, exchange rates, bond yields, and stock valuations. By understanding how inflation affects the Fed's decision and the market outlook, traders can gain an edge in a challenging environment. In this section, I will share some strategies and tips on how to grind out profits in a slump, such as diversifying your portfolio, hedging your risks, or looking for opportunities in sectors that benefit from lower interest rates. Diversifying your portfolio. This means spreading your investments across different asset classes, such as stocks, bonds, commodities, real estate, etc. By doing this, you can reduce the impact of any one asset losing value due to market fluctuations or other factors. Diversifying your portfolio with assets that aren't correlated to the dollar will go a long way toward isolating your wealth from interest rate risk. For example, alternative assets such as precious metals, cryptocurrencies, and unmortgaged or fixed-rate real estate can help you hang on to more of your wealth if rates rise. Hedging your risks. This means using financial instruments or strategies to protect your portfolio from adverse price movements. For example, you can use options, futures, swaps, or short selling to hedge against the risk of rising interest rates. Hedging can help you lock in a certain price or return for your assets, regardless of how the market moves. However, hedging also involves costs and trade-offs, so you need to weigh the benefits and risks carefully before implementing any hedging strategy. Looking for opportunities in sectors that benefit from lower interest rates. This means identifying and investing in industries or companies that tend to perform well when interest rates are low or falling. For example, some sectors that may benefit from lower interest rates are utilities, consumer staples, healthcare, technology, and housing. These sectors typically have stable cash flows, low debt levels, and high growth potential. They may also offer attractive dividends or buybacks to shareholders. These are some of the ways you can grind out profits in a slump by adapting to the changing interest rate environment. Of course, you should always do your own research and analysis before making any investment decisions. Remember that no strategy is foolproof and every investment involves some degree of risk.